Can we have deflation?
Actually, deflation is the nightmare of the central banks. Inflation is not the nightmare of central banks. You uh, uh, you increase your rates and you will kill growth, you will kill consumption, and will have a lot of people on the street, unemployed, and the job is done.
We're talking now about peak inflation, peak dollar, and perhaps peak interest rates. What does this mean for the markets? We'll talk about this with Alain Corbani. He is the portfolio manager of the Global Gold and Precious Fund at Montbleu Finance. And Alain, it's good to see you again. Thank you very much for being on the show, the David Lynn Report. Welcome.
Thank you very much, David. Always a real, genuine pleasure to be exchanging with you. And before we start, I want to congratulate you for launching the David Lynn Report, and I wish you the best and an exponential success that you deserve.
Oh, thank you. Thank you very much. I appreciate it. And I'm excited to speak to you again as well. Your analysis has been spot on. The last time we spoke, you were talking about peak inflation, peak dollar, peak interest rates. We'll talk about all of these things. So yeah, you were right on all counts. So let's start with interest rates first. In terms of the short term of the curve, 2-year yield, for example, it's been moving up along with the Fed funds rate. Interestingly, the long end of the curve, 10-year, 30-year, has been flat, if not slightly down in the year. Why is that? Why are we seeing this divergence?
Finally, somebody who's talking sense. Very few people understand that nominal rates have gone down from their peak of the fall of 2022. The 10-year in October 2022 was at 4.5%. We're today at 3.75%. The dollar peaked also in the fall of 2022, and the DXY, which is our reference, was at 114. We're now around 103. So, and inflation expectations are down. So, to answer your questions, nominal rates, the long-term nominal rates, the 10, the 20, the 30 years are down because they all are sending the same message. Inflation is not going to be an issue, and we are going to have a slower growth of the economy. These are the main reasons why those rates have started to go down since the fall of 2022.
Interestingly, we saw, as a result of this, the decline of the yield curve. If you take the long end of the curve, let's take the 10-year minus a 2-year rate, for example, the yield curve has been inverted since June 2022, more specifically July, actually. July was the first month it was fully negative, and it's been trending down ever since. And it's been exactly 1 year now, Alain, that we've had negative inversion in the yield curve. Where is this recession that people are saying will happen once the yield curve reverts? Please tell us about this pattern.
Great question. And we're going to try to not to be too technical. The consensus has been telling you that from the moment the yield curve turns negative, recession starts with a lag of 12 to 18 months. So if we really and this in a yield curve inversion turns positive before the recession starts. And they are relying on the statistics of the last 3 recessions, the 2020, the 2008, the 2001. And it's true that each time you had a yield curve inversion, 12 to 18 months down the road, this inversion returned positive and triggered a recession. And it happens in the last 3 recessions. But if we go back to further back in history, and if we look at what happened in the 80s, we still had the recession when the yield curve was inverted, was negative. So my point here is to say we don't need to wait for this yield curve to turn positive for a recession to occur, because history tells us that we don't need this environment to be in place for a recession to be triggered. So are we going to have a recession in 6 months? Are we going to have a recession in 12 months? I don't know. Frankly, I don't know. But the only thing that we should all remember is that when you have Fed fund rates at 5%, this is a restrictive monetary policy. I mean, no matter how you turn it, you must walk on the moon or Mars not to realize that a restrictive monetary policy will slow down the economy. And the economy is slowing down. And there are tons of data, tons, that are showing that the economy is slowing down. Are we going to have recession 3 months, 6 months, 12 months down the road? I don't know. What kind of recession are we going to have? I don't know. But the reality is that the economy is going to slow down. The unemployment rate is going to go up. And all the data, and we can go through them if you want, and we'll start with the leading indicators, are showing us that we are heading into a recession.
Yes, please just list a few of the leading indicators so we're aware of what to look for.
Well, the leading indicators, I mean, everybody's focusing on the unemployment rate, and they are telling us, but Alain, we are at 3.5% unemployment rate. How could we have a recession? But the unemployment rate is a lagging indicator. Recessions happen when the unemployment rate is low. So remember this. This is exactly what happened in 2020, what happened in 2008, in 2001, in 1990. 1990, I was looking for a job, and it was hard to find a job. So forget the unemployment rate at these levels. It doesn't tell you anything except that the economy is stretched, really stretched. What we are looking at are leading indicators. What we are and the leading indicator today is that -8. -8, that's back to the 2020, to the 2001, to the 1990 levels. This is number one. So negative leading indicators. The FiliFed, everybody's talking about the services, how the services are really the component of the economy that is maintaining the growth. Well, actually, we have, if we looked at the last data of the FiliFed, the non-manufacturing business outlook of the FiliFed, well, it has weakened. So this is also something we have to keep in mind. Average weekly hours. I mean, think about it. If you are an employer, before you start laying off people, you are going to ask them to work less. And this is exactly what has been happening, not over the last quarter or over the last 6 months. The trend of lower hourly weekly hours has been going down for the last 2 years. So we are working less because there is less business, and there is if you look at the Zillow, everybody's talking about how the shelter component of the CPI shows that there is a tension on prices, but and there's tension on prices because there is a strong economy. That's not the case. There is no strong economy. The last GDP, Atlanta Fed GDP number shows a growth of 2%, slightly under 2%, 1.9%. But do you really imagine a second that with rates at 5%, we can maintain a 2% growth rate, which was what we were hardly getting when rates were at under 2%, under 1.5% for years and years and years before the 2020 recession, since 2011 actually. So back to reality, the economy is slowing down. We are working less. those rates are punitive, and they are going to trigger, they are slowing the economy, and they will ultimately trigger a recession. What kind of recession? I don't have a crystal ball.
So the long end of the curve, the 10-year and the 30-year, could you say that they're more reflective of the markets or the bond markets outlook on the economy?
Yes, they are basically telling you there won't be a lot of inflation and we won't have a lot of growth. And this is back to what we had for the last 3 decades. So all those fixed income bears believing that the trend of the last 3 decades has inverted, and we're going to live in an environment with higher rates for longer. This is an element that I do not subscribe to, and for one reason, one simple reason: the service of the debt today equals 4.4% of the GDP. 4.4%, maybe doesn't ring, it doesn't, you don't visualize it. But the only moment in time, that's the second highest number in the history of modern economy. The only moment when we had a number that was higher than this was in 1990. So you cannot have higher rates because we have so much debt that the service of the debt is going to impact significantly the growth of the economy. It's you have your household, you have your income, and you have so much debt, and rates are going up that you're obviously going to dedicate more money to paying down your debt, or at least the interest, the service of the debt, and you will have less money to spend on the food, on everything else. So you are not going to spend more with higher rates. You're going to spend less. Your purchase power is going to go down. And this is exactly what I mean by a recession or a slower growth that is ahead of us for a long
So
time.
growth is slowing. You've listed a lot of indicators to show that the economy is deteriorating. Inflation has already come down, although not quite
Yes.
at the 2% target the Federal Reserve has. So
Yeah.
my question is, given all these things, why is the Fed still signaling another hike? Why is that necessary?
Listen, to be as candid as possible, uh, it's not because they wrote it, they didn't really say it, they wrote it in their
Okay.
projections.
Okay.
Even worse. It's black and white. But
What's the
uh,
difference?
but the difference is that they gave themselves enough margin not to increase those rates. So I think the message here is uh, if inflation doesn't show more signs of weakening, then we are ready to increase the Fed fund rates. This is basically the message, and this is why gold is not at 2100, 2200, or $2,500. It's because nobody really knows exactly what the central bank is going to do. Are they going to increase their rates in July, or are they going to stay put? We don't know. So the lack of visibility basically affects the price of gold. So to back to your question, sorry, the question is why did the Fed say that they might increase their rates again? Because they believe, let's give you a candid answer, because they believe that inflation hasn't been controlled yet. But we disagree with this statement. The 2-year inflation expectations 2-year, not 5 or 10. The 2-year inflation expectation has come down from 4% to 2% in less than a year. If you look at salaries, the two biggest components that when everybody's talking about inflation, forget the goods. The goods are not a subject anymore in terms of inflation because commodities are going down more or less. But the service part of the inflation expectations is salaries and rents. Salaries have stopped going up, and the second component, shelters, so basically rents, they are not increasing anymore. So we will see those numbers in the CPI with a 6 to 12 months lag. So the Fed gives itself room to maneuver, but the reality is that we believe that they will not increase rates because inflation is not anymore should not be is going to the future data should confirm the fact that inflation is not an issue anymore.
If you overlay, let's just we'll talk about gold in more detail later, but just on that note, if you overlay the gold chart with, let's say, the TIP ETF, TIP, which is an instrument that measures inflation expectations, there's an almost perfect correlation year to date, meaning that both gold and the TIP ETF have spiked around April or peaked around April. Gold peaked around May, actually, a little bit, but it's been trending down because inflation expectations have also been trending down, is my point. So the
yes,
gold market,
and that's why exactly, this is it. That's the correlation, the negative correlation between gold and interest and real interest rates. Absolutely, you're absolutely right. And the dollar, the direction of the dollar right now is more or less unknown. But instead of saying unknown, I would tell you that investors refuse to engage in whatever direction to take as far as the US dollar is concerned. In a nutshell, there is no evidence, the speculative positions, there is no evidence that there is any willingness to engage and bet against or for the US dollar today.
So when you talk about the gold price being negatively correlated with the real interest rate, what is the nominal interest rate component? Is it the short end of the curve that it responds to more, or
it's
the 10-year?
It's the 10-year.
Okay.
Yes.
Okay, interesting. Yeah, and that's been flat. So, well, let's talk about we talked about interest rates. Let's talk about the dollar now. Now, the dollar you brought up, it's been declining. Now, is that again? We talked about interest rates coming down. Is that mainly because of the long end of the curve coming down slightly or flat, or is the dollar anticipating other changes in the U.S. economy?
Well, I think it's the pendulum theory, and the fact that the U.S. dollar went as a counter-cyclical asset did perform extremely well in those the times of tension, and now we're back to a position where. We were at 24. I mean, the US dollar did come down by 6-7% from its peak, but it has still a lot of room to depreciate. But we don't expect the US dollar to depreciate significantly in the very short term, because a weaker US dollar will not help the data on the inflation front.
Weaker
And
dollar will not help. Okay, what do you mean by that? Yeah.
it means that a weaker dollar you will import inflation with a weaker dollar. Inflation will be higher if your currency is weaker. So, so we don't want a weaker dollar right away. We want a weaker dollar when our economy is going to be so weak that we'll need to revitalize the economy. And you revitalize the economy with a weaker currency.
Right. So actually, exports will start rising.
Exactly. And if the dollar is too weak, the imports will cost you more. And this is a way to import inflation. So the Fed doesn't want more inflation. So most probably the dollar is going to stay at these levels until we have a much weaker economy in the US.
Um, I was
So David, to summarize my
yeah.
my approach, phase one will have lower rates. Phase two will have a lower currency to fight the recession. This is the economics 101, literally.
I'm thinking all these things: lower dollar, lower inflation, and lower rates, or at least peak rates. All these things are positive for the equity markets, are they not?
The equity market wants to see earnings growth. If we head towards a recession, the probabilities to be disappointed with our earnings growth forecast is going to be higher.
What is the what are central banks around the world doing right now? Let's just take Europe, where you're based. The ECB, are they more hawkish than the Federal Reserve right
The
now?
ECB is uh, is unfortunately very political. It's not independent. So the ECB will say what Germany and France want them to say. And unfortunately, also the ECB has tendency to follow what the Fed is doing. So with some lag. So right now, the Fed is telling you, I'm going to keep my rates at these levels. Maybe I will increase them by another 25 basis points, maybe 50, and that will be it. And the BCE is basically telling you exactly the same thing. ECB is telling you the same thing. We're going to keep increasing our rates because inflation hasn't been under control yet. So did the dollar take advantage of the spread between US rates and European rates? Maybe, surely. But this is the past. The reality is that rates in the US are not going to go higher. And that's what we said 1 year ago, and we haven't changed our speech. Rates and nominal rates, long-term nominal rates, did go down from a year ago.
So let's assume that the dollar doesn't decline immediately and import this inflation like you were talking about. Why do you think inflation has peaked?
Inflation did come with a vengeance because of our money, helicopter money, all those this public money that was spent. But this is over. Literally, it's over. The fiscal policy is still very generous, but nothing close to what we faced in 2020 and 21, and even in 2022. So the largesse that was unique is that's over, and this is why we still have growth. By the way, if this help wasn't this massive, we would have had a recession much earlier than that. The fact is that we spend so much money that we don't have. uh, will end up resulting in a slower growth that we have now. I remind you that we were north of 4% in terms of GDP growth, not more than less than a year ago, and now we're down to 2%. So we have a slower growth. Why don't people understand that we have a slower economy when the GDP is telling you that the growth of the US economy has been divided by two in a year and a half?
Can we have deflation?
In actually, deflation is the nightmare of the central banks. Inflation is not the nightmare of central banks. You you increase your rates and you will kill growth, you will kill consumption, and we'll have a lot of people on the street, unemployed, and the job is done.
I ask this because if you take a look at, let's say, just the 2008 recession, we had a very short period of deflation. I think maybe one quarter. It wasn't a lot. It was like negative 0.3%. So it is possible. Now, what happened after that was
what did the Fed do?
They lowered rates.
Exactly. Yeah. Thank you. So you see, this is the remedy. The remedy. And 2008, if you remember 2008, I do remember it very well. Everybody, the consensus was so scared of deflation. That was really the topic, not of the day, of the week, of the month. That was really big. Deflation, and it didn't last very long. So now we're talking about inflation, but it's not going to last very long because you're going to have you are facing an economy that is contracting. This is what is happening. You don't have inflation when you have less consumers.
Let's put all this together then. I know you hate this next question, but I'm going to ask you anyway. Your outlook on the gold price. How do all these factors play in on gold?
We think that the central bank will be forced to cut its rates. And by the way, history tells you that in the 18 months preceding a presidential election in the United States, never did you see an increase in rates.
Okay.
No rate increase in the 18 months preceding a presidential election.
Well, I gotta say, maybe that's just a coincidence because remember, the Fed is supposed to be independent of politics.
Yes, let's say that the Fed is independent. The circumstances made it possible, or that rates never were increased 18 months prior to a presidential election. And this, even if this statistics is on our side, let me say it differently. A slower growth cannot and should not lead the central bank to increase its rates, which are already at a very, very punitive level. So lower rates heading into 2024. A significant slowdown in the economy. Call it recession or not, I don't know. But that will help a weaker US dollar down the road. And these two elements will help a higher price of gold because, as we said, we believe that rates will go down at a faster pace than the inflation. So real rates will be back into negative territory.
Maybe very quickly explain to the audience, because it's first time on this platform, that there is a negative relationship between gold and real interest rates. That the correlation has actually been very consistent historically. The inverse correlation, if you plot the two variables together. Why does this inverse correlation exist? Why does gold hedge against real interest rates?
Well, look at it this way. If you are in an environment with negative real rates, it means that the cash you have at the bank is its value is going down because you have inflation, and the interest that you are getting is lower than inflation that is eating your savings. So gold performs well in a negative real interest rate environment because gold doesn't deliver any coupon, right? So suddenly there is a competitive advantage to hold gold versus holding cash.
Could the logic not be applied to cash? Uh, my cash, if unless I put it in a money market fund, doesn't generate a yield. So, I'm just playing devil's advocate here. Why can't I, in a very low yield environment, just hold more cash instead of buying gold, which also doesn't
Okay,
generate
let's.
yield?
What is a low yield for you? 3%, 2%, 1%?
Well, let's say lower than inflation, because then I could just, if it's higher than inflation, I can put it in a
Exactly.
CD.
It's lower
Yeah.
than inflation. So you are losing money by keeping your cash.
Okay.
It's as simple as that. The 3% that you will have in your saving account will be lower than the 4% that the CPI is showing you today. So you're
Uh,
losing 1% on an annual basis in this specific example.
I understand. All right. Well, finally, let's talk about the gold miners, and certainly the GDX has caused controversy because while gold bullion is near its all-time highs, the GDX ETF is about 50% away from its all-time highs in 2011. And the reason for that, hopefully you can explain to us why that is, because a lot of people are confused.
This is a core subject. So for the last 7 years, I told all the shareholders and the prospects and investors in the Global Gold and Precious Fund, always told them, don't expect those mining companies to generate higher margins if the price of gold doesn't go up. The operating margins were totally 100% dependent on a higher price of gold. Usually, if you run well your company, you should not only rely on the price of your sub asset. You are relying on your capacity to generate a margin, a profit margin, because you're going to cut your cost, because you are going to gain on productivity or whatever. For the first time in 7 years, I'm changing my approach to those mining companies. I'm saying that, and the last quarter is showing is backing my statement. It's the first time in 7 years that costs of the mining companies as a group have come down. First time. Which means what? Which means that you can expect higher margins, not only from a higher price of gold, but also from lower operating costs. And this is when this class of asset performs really well, when they generate leverage, not only with a higher gold price, but or silver or platinum, palladium, whatever, and also because they are cutting their costs and improving their operating net margins or bottom line in a nutshell. And this is really, again, it's worth mentioning it because a real change of trend. We had 7 years of higher costs. Last quarter showed that finally those costs were under control and actually were lower first time. And if this trend is confirmed, expect those miners to deliver significant returns with a stable and or higher price of gold. The and or is really essential. This is the big change.
Okay, let's follow up on that as the miners move along with the markets. But excellent analysis. Thank you very much for your time. And where can people learn more about you, about your work?
Well, actually, thank you for asking. So, and again, I'm really pleased to do this interview with you today on my first day with Montbleu Finance. I joined them this morning with the fund that I've been managing for the last 15 years. Great people, great environment. I'm extremely pleased. So the name of the asset management firm is Montbleu Finance, and you can find them and can find us on the internet. And of course, I'm still managing the Global Gold and Precious Metal Fund based in Paris, France. So very happy for, well, time to celebrate your launch and a new start for me.
Yeah, this is great timing. You just started your the new fund today. Technically, it's a new fund today. New management. So congratulations. I'm happy I'm your first interviewer to talk to since the transition. So very honored. Thank you very much, Alain. I'm sure the audience has learned much from you. We'll speak to you again next time. Take care.
You too. Bye, David.
Thank you. And thank you for watching. To the audience, thank you for watching. Don't forget to subscribe.